Bismillahirrahmanirrahim and Assalamu alaikum everyone. This is Murtaza Quaid and today we are going to solve a past paper question of a very important topic from your future career and also from the exam perspective as well. Because we all know that how much the world is now concerned about the sustainability practices and sustainability reporting as well. That IFRS has issued a separate series of standard for these sustainability related matters and related reporting, right? So this is very important topic, and it is one of the most expected or predictable examinable topic or the area of your syllabus. So you have to make sure that you have a very good understanding of this area and also the ample practice of that sustainability standards, and that is why we are going to solve the past paper today in our session. So we have selected a past paper from the September-December 2024 attempt of the SBR. Now let us read it. It is the Kimimla Company manufacture petrol and car engines, right? So we have a company who is involved in the manufacturing of the petrol and car engines, and the financial year is 31st December 2007, and we all know that in reporting paper the year end, how much it is important, right? Because reporting is all about the financial reporting of the specific period, so we all should be very aware and focused on our reporting date, right? So next, there are few exhibit. The following exhibit available on the left hand side of your screen provide the information relevant to the question. All right, which are the exhibit which are available to us? These are sustainability report. It provides the information about the sustainability report produced by the Kimimla company for its investors. Okay, then we have climate change. Okay, outlines two areas of Kimimla company's financial statement which might be impacted by the climate change. So we are expecting to have some information in this exhibit related to the climate change which is occurring, right, and which can impact the financial statement of the Kimimla company. All right, then we have the share-based payment. Okay, what is given in this exhibit? Let us see. Outlines a share-based payment scheme for the directors of the Kimimla company. So there is going to be some sort of information regarding the share-based payment scheme which is given to the directors of Kimimla company, and we all know the IFRS 2, not S2. It is the IFRS 2 which is going to be applied on this share-based payment along with the sustainability standards, and we will see how it is going to be and how we are going to understand the question and then going to answer it. So now let's read our first part of question number 4. This is the question number 4 from the September-December 2024 attempt. In requirement, we have a part A1 which is asking us to briefly discuss how the materiality approach is different in European sustainability reporting standards compared to IFRS sustainability disclosure standards, right? So the requirement is asking you to briefly explain the difference between the materiality concept which is discussed in the European sustainability reporting standards as compared to the IFRS sustainability standards. All right, how many marks are we given for it? So we are given only 2 marks for it. Okay, and there is a specific note for us which is saying that note, you do not need to refer any exhibit when answering part A, part 1. So that means that this type of question is sort of a theory based question in which you do not need to apply any concept on the scenario or the company. You just have to reproduce the concepts of the standards, and I feel like it's a very easy question, right? And only 2 marks are given. It means that you are not going to give a single second above 4 minutes for this specific requirement, right? And let us discuss what are the differences. See, it's a very simple thing. that when I talk about the IFRS sustainability standards, the sustainability standards adopt the same concept of the materiality which is being discussed in the IFRS other standards. And what it is that the materiality is focused on the financial performance, position and cash flows of the company. The financial aspects which we look at while considering the materiality for your IFRS other standards, that is same being adopted in the IFRS as well. This is the thing in the IFRS sustainability standards. But when I talk about the European sustainability standards, the European sustainability standards talks about the dual materiality concept. And what it is? The dual materiality concept means that the first materiality which you should be adopting or which you should be considering is as same as in the IFRS sustainability standards, which means that the dual concept, okay, let me write it on here on the paper for you, that see in IFRS Alright, so that is what I have written here for you. To summarize, what I am trying to make you understand is that the IFRS sustainability standards, for them the materiality is same as the other IFRS standard which is focusing on the financial aspects. Alright, but when I talk about the European standard, it talks about the dual materiality concept. And what is the dual materiality concept is that it focuses on the same financial aspect as well as it also focuses on the significance of the impact on environment and society. So it means that it considers both the impact on the financial performance of the company and as well as the environmental and the society aspect while considering the materiality for the European sustainability standard reporting. And believe me, these 2 marks are the easiest and free 2 marks which are given in the exam, right? This is the blessing from the examiner that he is giving you this kind of theoretical based question which are free marks. So what mistakes student does, they waste the time into these kind of questions. They try to overthink that, oh my god, what is the materiality concept, how we are going to explain it, how we are going to connect these things, how we are going to compare it, are we going to make a table, are we going to make a headings, are we going to make up points. No need to think that much for only 2 marks. You have 4 minutes. Write as much as you can in these 4 minutes whatever the concept you have studied, and have faith that whatever you are going to write, it is going to correct, because you have done a lot of hard works, a lot of efforts, your teacher has put a lot of efforts. So whatever it is in your mind and your writing, have faith that it is going to be correct. Otherwise you would be in the confusion, in doubts, and you would be wasting time. And I do not want any one of you to waste time on that kind of 2 marks question, right? Let me show you the examiner sample answer, and then you can realize that whatever you are thinking, it's not true that writing the theoretical answer is going to be very tough and very difficult for us. If you would see that how examiner has written, and examiner has only given the due weightage to this part as well. He has not given he is not gone into very much detail. Let's see for the question number 4, part A, materiality. The same technique which we apply in our answer drafting, examiner has applied the same thing. That first is the examiner refers to the standards which is being applied here, right? And then it connects it with the scenario. And since we do not have any scenario here, we would just explain them what is being discussed in the IFRS sustainability standard and the European sustainability standards. And what it is the materiality in IFRS sustainability disclosure standards, it's a name, is based on the financial materiality, which focuses on how sustainability issues affect the financial aspects of the company. This thing I have made it even more summarized for you. If a student is writing if that much answer, he will get 1 mark, because he has explained the materiality concept in the IFRS sustainability standards. And then when I talk about the European sustainability standard, materiality in European sustainability standard is based on a concept of dual materiality or double materiality. Tell me, is there anything difficult in it, in saying just these lines? I do not think so, right? Then this focuses on financial materiality as above here. Now you are explaining the dual materiality. First you stated that it focuses on the dual materiality, and then you go towards the explaining the dual materiality in a very brief line, that financial materiality as explained above, and also focuses on impact of materiality. What is impact materiality? Impact materiality is which is how the entity impacts the environment and society. Khalas, that is all which you need to draft in this answer, and that is what examiner has drafted. See how examiner is writing or drafting the way you used to draft, the way we used to draft, we used to discuss, and no need to do anything fancy or try to waste time in thinking too much to make the answer very, you know, first class or A1 or fancy, please. Right? So I believe this part or these kind of question, see, I have gone into too much detail explaining you how to draft the answer or tackle these kind of question. Why? Because only this was the 2 marks question, but just to make you understand that how to deal with the theoretical question or these kind of question which are not linked with the scenario. And I hope that I was able to explain you and make you understand this thing and make it easy for you. So see you in the next lecture where we will solve the question number 4 part A, part 2 in detail. So till then, take care of yourself. Allah Hafiz. So in last class we solved question number 4 part A1, and now we are going to look at the question number 4 part A2. Let's read it together. It says that using the exhibit 1 only, not any other exhibit. Okay. Discuss why Kimimla Company sustainability report does not comply with the IFRS sustainability disclosure standards. There are professional marks which will be awarded in part A2 for the clarity of the answer and for the specific use of the IFRS sustainability standard disclosure standards. So this total marks, total 10 marks question, right? And what you are required to do, you have to require the weaknesses, deficiencies, issues which are in the Kimimla company's sustainability related disclosure or the report. Okay. And how you would be doing this? If you have the good concepts or the understanding of the IFRS sustainability related disclosures or the standards, then you would be able to find out the mistakes, omissions or the issues in the report as comparison to your concept that IFRS sustainability standards ask you to do something and in report it is not done, or it is done but in the wrong way. That is what you need to do. So it seems again a very easy question and an easy requirement, and it is for the 10 marks, right? So the professional marks are for the clarity of the answer, and we all know that the clarity element we are going to follow in all of our answers so that our examiner understands our answer properly and we would be awarded with the good marks, right? So now let's go to the exhibit 1 and read it and see what is there for us in the exhibit number 1. So the exhibit number 1, here we have exhibit number 1 says that Kimimla company has produced a sustainability report. All right. Sustainability report states that it has been produced in accordance with the IFRS sustainability disclosure standards. All right. So far, nothing wrong I have seen, right? Due to the system issues, Kimimla company was unable to capture important data during the December 2007. As such, its sustainability report covers the 11 month to 30th November 2007. Now this is the issue. So what we have studied, that your sustainability related disclosures, for how much period they should be. I need you to tell me. Think about it. Yes, you are thinking right that your sustainability related disclosure should be of the same period as your financial statements are. And financial statements are prepared for the 12 months in general scenario, because we are not given any other information. So in normal scenario, in general scenario, in 99%, 12 months. But, and what is the 12 month end? It is 31st December 2007. So this is the 12-month period, right? But the sustainability related disclosures, they are for the 11 months only, and this is the mistakes. So we are noting here it should be of the 12 months as equal to your financial statements. This is the number one issue which we have identified, right? And tell me, is it something very difficult? Is it something very complex? I do not think so. If you have studied the IFRS sustainability standards, if you have taken the lecture, right? And it is, even if a student has not taken the lecture, it's a common sense that both of the reports which are interrelated, interdependent, they should be of the same period. Let's move forward. In climate related disclosures, Kimimla company has identified several climate related opportunities. Okay. It has also identified climate related physical risk, but no other type of risk. So this is the issue. Let me recall you that in IFRS sustainability standards, that is the S2, climate related disclosures, it asks you to provide the risk which are both physical and the transition related risk. And Kimimla company has only identified the physical risk. So they have missed the transition risk. But they are saying there are no other type of risk. So that means they have not missed it. No, I would still say they have missed it, because they are saying there are no risk, but in fact, in reality, there are risks. There is one transition risk. Let me tell you, let me take you to the opening paragraph. It says that you are a manufacturer of the petrol car engines. And don't you think that the world is going to the sustainability practice? They are going towards the renewable energy, environmental friendly products, and soon the petrol is going to end. And also, if it doesn't end, the people are going to shift towards the electronic vehicle. So if the people are moving towards the electronic vehicle, electronic car batteries or the solutions, don't you think that the demand for the petrol engine would also decline? Because if people are not using the petrol as their fuel, so what is the use of the petrol engines, right? So over the period, your demand is going to decline because you are making the engines, right? And it will have the impact on your financial performance as well in the future. So this is the transition risk, and it is not identified by them. So they have missed to identify the transition risk. And whatever the discussion we have done right now, just right now, that is what you need to mention in your answer, and it would be a very good answer. I will show you how. All right, now let's move forward and read it further. For the risk and opportunities identified, Kimimla company has disclosed the potential impact on its financial position and financial performance over the next 12 months. I have seen two issues into it. And can you guess it? Yes, you can. The one is very easy, and the one I am feeling that only few students would get it, and if you're not getting it, it's not that much important. The thing is that they have identified risk and opportunities for only 12 months period, like for the next year. But whereas if I remember, or what I recall, that IFRS S1 or the sustainability standards, they ask you to disclose or identify opportunities and risks which are in short, medium and long run. Don't you think that only 12 months does not satisfy all these three terminologies? Not at all. So that is the issue, that it is good that you have identified for the 12 next months, but you should also identify risk and opportunities and their impact for the short, medium and long run, all of them. Okay. And the other issue is that they have identified the impacts on the financial position, that is the balance sheet, financial performance, that is the P&L. What about your cash flows? Don't you think that the cash flow is one of the most important element of your financial statement? Yes sir, it is. It tells you about a lot about your financial cash flows issues, cash flows difficulties, good position or the availability of the funds. So the cash flow, it is missing, right? So the cash flows impact is not covered here. All right, let's move forward. Kimimla company has disclosed its scope 1 greenhouse gas emission. It has not disclosed scope 2 or scope 3 greenhouse gas emission on the basis that these figures are difficult to measure. Kimimla company believes that this level of measurement uncertainty would not be useful to the primary user of the financial statement. All right, so I have again seen two issues here, and this is that scope 3 greenhouse gas emissions and the scope 2 greenhouse gas emissions are not disclosed. And what are the basis? That they are difficult to do. Are you guys able to recall any of the standard which you have studied from your beginning? It says you that if something is difficult, you can leave it. Can the difficulty be the criteria of leaving something or exemption from some requirement of the standards? Not at all. They have done this mistake. So this is the issue. You are not allowed to leave out or miss or omit any specific disclosure or any specific requirement of standard, any standard, on the basis that it is difficult to do, right? Number one. So let me write something for you. So this is not the criteria. This is not the correct criteria for the exemption. So then if it is not a correct criteria, then what is the correct criteria? The correct criteria is that the entity is allowed to leave out or omit the scope 3 greenhouse gas emission in only of its first annual report, which is made as per the sustainability standards. When you are applying the sustainability standards for the very first time, in that year only you are allowed to leave out the scope 3 greenhouse emissions. Otherwise, no entity is allowed to omit this. All right. And the other thing is that they are saying that the uncertainties or the assumption which we have taken in these calculation, they are of no use for the users. Don't you think that the uncertainty or the assumptions which you have applied in the evaluation of the impacts on your financial statement are also useful for the users? Like if they would know about the assumptions or the uncertainties which are involved in the evaluation or determination of the impacts, they would be able to understand it in a more or in better way. Yes, it does. And that is why in financial statements as well, wherever we are taking any estimates or there is a involvement of the policies, that if the policy changes, it will have the significant impact on the financial statement, or if the estimate changes, it will have the significant impact on the financial statement. We disclose this fact. We disclose even the sensitivity analysis in the financial statements as well. Then why not in the sustainability standards disclosure? It should. So the level of uncertainty and the assumption, they are very useful for the primary user. They can evaluate the impacts based on the uncertainty if they know about the uncertainty. So this is another issue. So this is wrong assumption. All right, then let's move forward. Several years ago, Kimimla company introduced a share-based payment scheme for its directors. Okay, the option would vest on 31st December 2007 if Kimimla company cut its scope 1 greenhouse gas emission by 10% per year on average. All right. So we all know about the IFRS sustainability, IFRS 2, that in share-based payment, which are the scheme which you are giving to your employees. In this case, it is given to the directors. You record a share-based payment expense over the period and you maintain the share-based payment reserve. So at the end, when you are going to issue the shares, you would issue them from the share-based payment reserves, right? So here, what is the target? The target is that the Kimimla company, if the Kimimla company reduces, cut its scope 1 greenhouse gas emission by 10% per year on the average. This is the target for the directors. The target was not met and the scheme did not vest. No mention is made in the share-based payment in the climate-related disclosures. Don't you think that it is wrong? Sir, why? Let me explain you. Can you see this word target? And can you recall something from the IFRS S1 and also S2, that in your sustainability disclosure you are going to disclose your targets and your metrics of your performance, of your objectives, what you are going to do related to the sustainability, and also their results. And this target, this share-based payment scheme, this is not some ordinary share-based payment scheme. This share-based payment scheme is linked with the sustainability because it is talking about cutting the greenhouse gas emissions. So this is not the ordinary share-based payment scheme, and it should be the part of the sustainability related disclosures. And also it should be disclosed that the Kimimla company was not able to meet the target. So the omission is not correct, right? It should be disclosed because this target is related to the sustainability. Moving forward, related disclosure detailed Kimimla company target of becoming net zero within the next decade. So the climate related disclosure says that the Kimimla company is going to become the net zero from the perspective of the carbon emission. And what do I mean by the net zero? Net zero means that it is not possible that the company is not emitting any carbon or not doing any carbon emission. It is, but they are also doing some things which are, first they are emitting the carbon dioxide and then they are doing some sort of arrangement which are absorbing these carbon emission. So on the basis, we will say how much you have emitted and how much you have absorbed. For example, if you have emitted 100 tons of the carbon dioxide and you have absorbed the 100 tons as well, so that means on net basis you have done zero carbon emission. This is their target for the next decade. Okay, and it is disclosed in the sustainability climate related disclosure. Now what, around half of its anticipated carbon reduction is estimated to arise from the carbon credits. There is no reference to the use of the carbon credits in the disclosures. So what there is something named as carbon credits and many of the students do not know about it. Let me explain. That the carbon credits, these are, for example, these are the credits which are given by the United Nations to the different countries who are emitting carbon in top 10, top 5 list. Then these carbon credits are given to the government of those companies, and then the government gives these carbon credits to those companies you know what, who are sustainable, who are not emitting carbon. So they are given the credits, and credit means the benefits, right? So they are given the benefits, and then these companies either avail these credits themselves, or even these are sellable instruments. They are sellable instruments that they can sell these carbon credits to those companies who are emitting carbons. And why the other companies would would purchase these credits from them? Because they are emitting carbon dioxide, which is harmful for the environment, country, and the society. So in order to, because they are emitting the carbon dioxide, they would be penalized, they would be facing fines, and also the backlash from the society as well. So what do? They purchase these carbon credits, which are sort of the compensation from them, or because of their carbon emission. So they compensate. So the Kimimla company is emitting carbon dioxide right now. So Kimimla company has to buy the carbon credits from those companies who are not emitting the carbon dioxide or the carbon other emissions, right? So they are planning to reduce their emission and going towards the net zero in the next decade. So right now they are purchasing the carbon credits, and this is not disclosed in the disclosure that they are purchasing carbon credits and which nature of the carbon credits they are purchasing. So this is, I guess, incomplete information, because this net zero thing and the carbon reduction, right, they are planning to becoming net zero and cut their carbon emission. So this is related to the carbon credits, and it should also be disclosed in the disclosures, right? So this was the whole analysis of the scenario. How many points have we identified? Let me just count them. Number 1, number 2, number 3, number 4, number 5, number 6, and number 7, number 8. So this was the 10-mark question, and we all know that one good point is, equal to 2 marks. If it is, it is a very easy or a simple liner mark, then you could say that it is 1 mark. But on general basis, only one good points give you the 2 marks, right? So even if the student identifies 5 issues out of all these 8 issues, that is, student would still get full marks, right? Why I'm telling this? Just to make you comfortable and confident that how much easy it is to avail full marks. You're not supposed to identify all the issues, and obviously these 8 issues, some students would find other 5 issues and some would find other 5 issues, right? And both of them could be correct. How? Because of there are more issues present in the report, more than the required marks. This is what the thing which a student need to consider and keep in mind, right? So now let us move forward and see the sample answer. Why I'm making you see the sample answer for these theory based question? Because I want you to see how the examiner is drafting and realize that examiner is not doing anything fancy. Examiner is just following the technique which we used to follow in our classes, which we have learned, so that you can feel confident, you can feel comfortable, and you can write or draft the answer in the exam as well, without wasting so much time in thinking too much to how to start it, how to link it, or do something fancy, right? So now let's move towards drafting of the sample answer. Alright, so here we have the sample answer. Let us read it. See, let me first show you the points which we have identified and what examiner has identified, right? Number 1, the timing of the reporting which we talked about, it should be equal to the financial statement period. Number 2, it is talking about the risk. what it is talking about, it is talking about the transition risk, okay, and also it is talking about the cash flows impact which we identified, and also it is talking about the short, medium and long term. So the points which have been identified by us, they are also identified by the examiner as well. And then greenhouse gas emission, this is what we were discussing, that it has only disclosed the scope 1 greenhouse gas emission, and IFRS S2 requires you to scope 1 and 3, 2 and 3 both, right? This is what we just discussed and identified. And then what it has identified more about the target, so it should disclose the target which is related to the share-based payment, right? And then what we are doing is there's something more related to the thing, that this target is related to the sustainability standards and it is not satisfied. This you have to give the full and complete disclosure. Then if I talk about the carbon credits, this issue is also identified by the examiner, that the this target of reducing the 50% of the carbon credit, this should also be disclosed, and also the type of the carbon credit should also be disclosed in the disclosure. So see, these are the same points which we have identified, are identified by the examiner, right? Now let's read how examiner has drafted it and how we used to draft it, or how we are going to draft it. So very simple, according to the IFRS S1, the name itself, the way we start our answer, we always first state the standards or the requirement of the standard which is applicable here. So the IFRS S1, the sustainability report, what does it say? It says that the sustainability report should cover the same reporting period as of the financial report. This is what we discussed, and this is what in the discussed in the IFRS S1, and it is copied in the answer, and that is what we used to do, which is 12-month period to 31st December 2007. And also you can add one line that Kimimla company has reported only 11 months, which is incorrect. That's it. So your point is done and you will get 2 marks. Next, about the risk. Again, see, examiner is starting from the standard. It is stating the relevant part of the standard or the relevant requirement of the standard. According to IFRS 2 climate related disclosure, users should be informed about both physical risk and transition risk. Tell me what it is difficult to write this line. There's nothing difficult if you know or if you have studied the standard. These, and then what we are going to do, we are going to connect it with our scenario, that this is the requirement, what has been the scenario or what has been done by the company. So these are likely to be significant. Who these are? These are the transition risk which the Kimimla company has missed out. Okay, so we are saying that these are significant because why? They manufacture petrol car engines, and the market for these is likely to diminish as the demand for the lower carbon alternative increases. Tell me, is there anything difficult in drafting this or writing this thing? How easy it is. Just mention the requirement first and then just link it with the scenario that the transition risks are missed by the company and they are significant. Why they are significant? Because the demand for the petrol engine is going to decline, because in the future the alternatives will come. The world is moving towards the sustainable practices and the alternate to the these harmful products. That's it. What is difficult into it? See, why I'm making you read it, because to make you confident and comfortable that this is how the examiner is even drafting. Examiner is not doing something very extraordinary. He is also doing the same and applying the same technique which we used to do. Next, for the risk and opportunities identified, Kimimla company has disclosed information about the impact on the future performance and position, that is the P&L and the balance sheet. This is what the scenario, the examiner has discussed the scenario, that it is done. Now tell them what is wrong in it. What is wrong? The Kimimla company should also disclose information about the impact on the cash flows. That's it. Done. Point is done. You just discussed that you have disclosed the impact on the financial position, financial performance, you have missed out the impact on the cash flows, which is a significant component of the financial statement. That's it. Moving forward, moreover, the other issue, Kimimla company has only disclosed information about the impacts over the next 12 months. This is the fact from the scenario. Now what IFRS S2 states, you can do flip side, that first you state that IFRS S2 requires you to disclose the climate related impacts or risk and opportunities over which have the impact over your financial statement over the short, long and medium run. And whereas the Kimimla company has only disclosed the impacts for the next 12 months. That's it. The company should disclose the impact over the short, medium and long run. Believe me, this is the easiest technique, and why, I don't know why the student gets too confused into it, right? Next, the greenhouse gas emission. Kimimla company has only disclosed its scope 1 greenhouse gas emission. That's the fact from the scenario. You took something from the scenario that it is happened, it is occurring in the scenario. Now IFRS S2 states that entities should also disclose information about S2, scope 2 and scope 3. That's it. That's the requirement of the standard which you are just mentioning. Nothing from your side. From the scenario, from the standard, and then note, Kimimla company would be exempt from the disclosing scope 3 greenhouse gas emission in its first annual report. Again, this is the standard requirement which you are mentioning. Now you would wording that what is the issue. You would say that the omission of any disclosure should only be based on the exemption which are provided in the standard, and the difficulty to gather the data is not a valid criteria, valid justification for the omission of any disclosure. That's it. This is what you need to just do, right? And this is done here, that although it can be difficult to measure the greenhouse gas emission, particularly scope 3, but S2 prescribes the use of the greenhouse gas protocol. This is something which I think that you don't need to mention. Just leave it. And then the other thing is that the measurement uncertainty will arise. Obviously, because it's a judgmental thing, it involves the subjectivity, complexity and also use of a lot of assumption, right? But that doesn't mean that you are not going to give the transparent view to the primary users of the shareholder. Kimimla company should disclose the information about its measurement approach as well as the inputs and assumptions used. These are the transparency element. If you're not going to tell them the uncertainty and assumption which are involved in the in determining the impacts, how they would be able to understand it clearly. You should mention these things, right? This is what the examiner has just mentioned. So in very easy or in very simple wording you are going to do and apply this technique and draft your answer. Then about the target. According to IFRS S2, company should disclose the targets which it has set. Simple. Now, share-based payment was a clear target to reduce the greenhouse gas emission by an average of 10% per year. Again, this is from the scenario. You have just picked it and just mentioned that this target is not an ordinary target. It is related to your sustainability related target. And if it is related to sustainability related target, it should be made part of your sustainability related disclosures. Kimimla company should also disclose the metrics used, and also you should use the matrix, the target itself, the objective. Obviously, when we talk about the target, what do we have in the target? The target has the metrics, that means the benchmark which you need to obtain. The objective, what is the objective behind doing this, right? And the period of the target, that in which period and how long period would it take you to achieve this target, right? This is what you need to mention. And even if you do not mention this, I do not think that examiner is going to deduct so much marks of you. You've just mentioned that the target should be disclosed and that's it. It's fine. Next, it should also disclose the fact that it did not satisfy the climate related target. Simple. You have to give the complete information. So the completeness aspect was missing. Once you have, you identified that you are not able to meet the target, why you are not disclosing this fact into the report, and why you are not being honest with your users? You should be. Next, carbon credit. Kimimla company uses carbon credit, and now when you are using the carbon credit, according to IFRS 2, you should disclose it. And you should also disclose the fact that 50% of the carbon reduction target is based on the use of carbon credit. So what, right now you are using the carbon credit. So 50% from the use of the carbon credit, you would reduce the carbon emission. So you would not be needing to, purchase those 50% carbon credits in the future, because you have reduced your emission. This you need to mention. Why you're not giving this information into the report? This is our concern, and that is what we are going to mention it in the exam. Also, you should give the types of the carbon credits used and the other factors. That's it. Believe me, this was the easiest way to draft it, and examiner has done the same thing. Nothing fancy, right? So I hope that I was able to explain all the concept being tested in this question regarding the IFRS sustainability standards, and also was able to explain you how you're going to approach the question, how you're going to draft the answer. So see you in the next part, where we are going to solve the question number 4, part B. Welcome back to the past paper practice session, where we were solving the past paper related to the IFRS sustainability standards. In previous lecture, we covered the question number 4 of the September-December 2024 attempt, question number 4 part A1 and question number 4 part A2. And in today's lecture, we are going to cover question number 4 part B. Now let us read it together and see what it is asking us. Using the exhibit number 2, discuss the impact of climate change on the following issues in the Kimimla company's financial statement for the year ended 2007. Financial asset and recognition of the deferred tax. It is for 6 marks. So that means that there are 3 marks for each of the line item in the financial statement on which the climate change have the impact. Okay, and you don't need to assess the impacts on any other line item of the financial statement. You are only required to assess the impact on these 2 items. The information related to these 2 is presented in the exhibit 2. So now let's go to the exhibit number 2 and see what we have here. So for the exhibit number 2, Kimimla company is currently assessing the impact of the climate change on its financial statement. You have given the information about the financial asset and the deferred tax. Let us read the financial asset first, discuss the treatment of the financial statement first, then we will go towards the answer, and accordingly after that we will solve the deferred tax asset part. Kimimla company has extended loans to its key supplier to help ensure their viability. Okay, so when I talk about the loan, these are the financial asset. Why sir these are financial asset? Because as per the IFRS 9, the financial instrument that is receivable for you and payable for any other party, it is a financial asset for you. So it's a financial asset and IFRS 9 would be applied on it. Alright. Kimimla company has recognized these loans as a financial asset. Okay. Kimimla company holds loan of this type within the intention of collecting the contractual cash flows. So we all know that if you are holding any financial asset with the intention that you will hold them to collect the cash flows till their maturity, obviously the loan is going to be hold till maturity, then they are classified using the amortized cost model, right? And every treatment or every requirement of the IFRS 9 under the classification of the financial asset in the amortized cost model will be applied accordingly. Moving forward, Kimimla company and its supplier have been affected by wildfires and flooding. Okay. In addition, there have been considerable policy and regulatory changes which have affected all the parties. Significant uncertainties exist around the impact of the climate change scenario on the Kimimla company and its suppliers' business model. Now it triggers a risk into my mind if I am thinking about the Kimimla company's financial statement, that I have a loan receivable from my supplier. my suppliers are being affected by wildfires and flooding, policy and regulatory changes. There are uncertainty in the environment regarding the climate change which are affecting the supplier's business model. Also Kimimla, but for now they have to pay it. So when I talk about these all things, it comes into my mind about the impairment of the financial asset, that IFRS 9 requires you to assess the recoverability of your financial assets, okay, and based on that you have to record the expected credit loss allowance. That means that you, because your financial asset, they are exposed to the credit exposure or the credit loss, and you have to assess that if there is a significant change in the credit rating of your supplier or the credit risk, if there is a significant change, then you will have to record the significant loss over these financial assets. If there is no significant change in the credit risk, then you will have to record the 12-month ECL allowance as you have been recording as per the IFRS 9. So this is what I feel like the impact is, that your financial asset, they are exposed to the credit risk because of these all things, right? And your supplier's ability to pay is under the question, that whether or not they would be able to pay you the full amount or not, and accordingly you have to assess that how much ECL you have to record, one thing. And the other thing is that how much change in the credit risk has occurred because of this event. If it is not significant, you have to record the 12-month ECL. If it is significant change, then you have to record the lifetime ECL. And not only this, if there is a credit impairment in the financial asset, first we are talking about the expected credit loss. It is based on your expectation. But if the credit, the financial instrument, they are credit impaired actually, then you have to write off the financial asset to the extent they are being impaired as well. So these are the implications of the IFRS 9 which you have to just mention, which I just discussed with you in the scenario. Using the same technique, that you will first mention that the IFRS 9, how IFRS 9 is applied, that this is the financial asset and IFRS 9 is applied, right? And as per the IFRS 9, these financial assets are exposed to the credit risk, and you have to evaluate it, and accordingly you have to tell them the treatment which IFRS 9 asks you to apply on the financial asset, and it will have the impact on the financial statement. Now let us go to read the sample answer. Here we have the sample answer provided by the ACC examiner, and see, there is no rocket science or fancy thing which examiner has done. Let me show you. Financial assets are measured at amortized cost and therefore fall within the impairment requirement of the IFRS 9 financial instrument. This is what, see how the examiner has first given the entry to IFRS 9 into the answer, that first IFRS 9 is applied and these are carried on the amortized cost and the impairment requirement applies. That's it. Moving forward, climate related matters may affect Kimimla company's exposure to credit loss. If you are not getting this line, if you are not writing it, it's fine. You can directly start from this, that the wildfires, flood and the policy and regulatory changes could negatively affect the borrower's ability to meet its debt. This is what we thought and that is what we have written. So that whatever you are thinking, just mention it and believe me, your answer is correct, right? Debt obligation to Kimimla company. Further, assets could be affected by climate change which would result in the reduction of their worth as security for the loans. What does it mean? It is saying that whenever you give a loan to anyone, you take the security of assets, collaterals from them. So because of the changes in the environment, flood, wildfires, don't you think that these assets or the collaterals or the security which have been given to the Kimimla company by the supplier would be affected as well, and their worth would have reduced, because you were thinking that what if the supplier would not repay me, I will go and liquidate those assets or the securities. But what if those securities are also affected by the wildfire or the floods, right? So you have to consider this thing as well while you are assessing that how much credit risk you are exposed to, how much shortfall in the repayment you would be facing. You have to check. In recognizing and measuring the expected credit loss, IFRS 9 requires the use of all reasonable and supportable information which is available without the undue cost or efforts. So you have to just mention that IFRS 9 requires you to consider all the scenarios. What all the scenarios? These all scenarios which you just mentioned it, right? Then you mentioned the scenario, you mentioned the requirement of the IFRS 9. Now what to do? Now conclude your answer and explain that as per this is the scenario, this is the requirement of the IFRS 9 and what is going to be the impact of the financial statement. Climate related risk matter therefore be relevant. They will affect the range of potential future economic outcome. That is what just I explained to you, that yes, climate related changes are relevant to you and you have to consider it for the impairment working or the impairment evaluation. Kimimla company will need to assess whether there has been significant increase in the credit risk and whether the loans are credit impaired. These are the two things which you need to consider. If they are credit impaired, write them off. If there is a significant increase in the credit risk, then you have to go to the lifetime allowance. See, in turn, expected credit loss are required to be measured through loss allowance at an amount equal to the 12-month expected credit loss or the full-time expected credit loss. See how beautifully examiner did not make any comment that go for the 12-month or lifetime. The examiner simply mentioned that you have to consider the change in the significant, you have to assess the increase in the credit risk, okay, significance of the increase in the credit risk, and accordingly you have to evaluate that whether 12-month or lifetime. Examiner did not comment it, he just give you the information that as per IFRS 9 these are the two options and you have to apply it based on the significance of the credit risk increase, right? Because we don't know, this is a material thing and you do not have the materiality of the Kimimla company, that how much material it is, how much significant it is. So when you don't know, you just have to mention that you have to consider the significance of the increase of the credit risk and accordingly either you will record the 12-month ECL or lifetime ECL. That's it. Wasn't it easy? See, first it mentioned the scenario, then the standard, and then the solution from the standard, that what is the treatment as per the IFRS or the standard. Now let's go to the deferred tax part and see what it is telling us. Deferred tax has, Kimimla company has been loss making for the past 2 years. The losses can be carried forward to reduce the taxable profit in the future. Kimimla company has recognized material deferred tax asset in respect of these losses. We all know that these losses, we can use them to adjust in the future taxable profits, to adjust them with the future taxable profit and avail the benefit. So that is why we record the deferred tax asset on the unused tax losses, right? So Kimimla company has done the same thing. Now what is the issue? Many of the Kimimla company suppliers are incurring cost in order to reduce the carbon emission during their production process. This will cause the purchase price of the raw material used by the Kimimla company to increase. You are currently in the loss, and if your purchase prices are also going to increase, don't you think you won't be able to become a profitable organization? This is a chance. Because see, when you are recording the deferred tax asset, what does it mean? Deferred tax asset can only be recorded for in that condition that you are expecting the future taxable profits, right? You are expecting the future taxable profits, and here we are saying that your purchase price is going to increase. So how you would be able to avail the tax benefit? See, what happens is that, for example, if you have 100 of the unused loss, right, and then you have the profit of 120 in the next year, you will adjust it and say I do only have 20 of the profit and I will give the tax on this profit of $20. Alright, but the issue is that you are recording deferred tax on this unused losses in the expectation, in the assumption that in future you will be profitable and you will be using these unused losses against this profit. So that is why we are recording the deferred tax, that this loss will give me the economic benefit in future. But if you are not going to be profitable in the future, how these losses are going to give you the benefits? No, they cannot give you the benefits because you do not have any profit to adjust them with it, right? So that is the issue. Also, due to the increase in the popularity of the electrical cars, Kimimla company has forecasted a decrease in the demand. And not only this, your purchase price is going to increase, your demand is going to decrease. Both of them will not help you to become the profitable. So if you're not getting the profits, don't you think that these deferred tax assets should not be recognized? Because deferred tax asset can only be recognized when you have the probable future taxable profits. But as per the scenario, it is very uncertain, or it is highly unlikely that Kimimla company is going to be profitable in the future. So if it is not going to be profitable, it cannot use these losses. So this is what you have to draft in the answer. Let's see what the examiner has written here. Deferred tax asset for deductible temporary differences. Obviously the asset is recorded on the deductible temporary differences, and unused losses and credits which you can use in the future to get the future economic benefits. Alright, so you record the deferred tax asset on them as per the IFRS 12 income taxes, to the extent that it is probable that the future taxable profit will be available against which those amounts can be utilized. These amounts, what? These differences, losses and credits could be utilized against the profits. They will reduce the profit and the taxability. But the condition is that you first have what? Future taxable profits, only then you can use them. Currently you are not, I cannot see that Kimimla company is going to have the future taxable profits. Now see, suppliers are likely to increase their prices. This will lead to lower profits in the future period. This is very simple line which you can write by reading the scenario, that suppliers are going to increase your prices, which will increase or decrease your future profits. Simple. Now move forward. Company products are likely to become less popular, and this will have a negative impact on the future profits. So again your future profits are getting declined, right? The impact of the climate change is creating uncertainty. This is likely mean that the Kimimla company cannot forecast future profits with much certainty. You need the probability, but certainty is not there. The climate change is very uncertain. So these all things indicates me that you should not record the deferred tax asset in the current year on your losses, because you are not going to get any economic benefit from them in the future. You would not be able to get. And also the deferred tax asset which you have previously recorded, this is also of no use for you. You will not be able to get the benefit from them. Why? Because you will not have profit in the future. This all scenario explain this thing. So the result or the conclusion is that the above result, as a result of the above, future profit may be less likely, that the Kimimla company may be able to recognize the deferred tax asset, or could be required to recognize the deferred tax asset which were previously recognized. See how easy or simple language which the examiner is using, and you also have to do the same thing. Just make the separate paragraph, okay, and one by one keep mentioning the concepts, keep mentioning your points, and then reach to the final verdict that as per this standard this should be done. Based on these things, standard requires you to do this, and simple, that's it. So this was the answer of the question number 4 part B. I hope that I was able to explain you it in detail and explain you how to draft the answer. See you in the next session where we will draft the question number 4 part C in detail. Welcome back to the classes where we are solving the past paper related to the sustainability standards. And we were solving the question number 4 of the September-December 2024 attempt. We solved question number 4 part A and B in our previous lectures, and today we are going to solve our question number 4 part C. Now let's read it together and see what is required from us in this part. It says that using exhibit number 3 in accordance with the IFRS S2, so the standard is also being shared with you that you have to follow this standard or apply this standard and explain how share-based payment should be accounted for in Kimimla company's financial statement for the year ended 31st December 2007, and you have to show all calculations. This was the 5 marks. So now let's go to the exhibit number 3 and see what we have there for us. Exhibit number 3, share-based payment. What it is saying that on January 2004, Kimimla company introduced a share-based payment scheme for its 10 directors. Let me highlight the important information which is required to be incorporated in our calculation, right? Because in requirement it is mentioned that you have to show all the calculation. So I have to identify these all elements, and I will explain you later when we will be performing the calculation, right? Each director was granted 15,000 share options. The fair value of an option at this date means the grant date on which the share-based payment scheme is being granted to them, and the fair value at the grant date is $8 per option. The option would vest on 31st December 2007, so that is the vesting date. Okay, it is the grant date and it is a vesting date. So there is 2000X4, X5, X6 and X7. These are the 4 year, that is the vesting period, right? 4 year is our vesting period. Okay, so moving forward, if Kimimla company when it will vest in 31st December 2007 if Kimimla company cuts its scope 1 greenhouse gas emission by an average of 10% per year over the 4 year period. That means that, for example, if 10% in X4, 12%, then we have 8%, and then we have, let's say, 11%. So what do you think, that is the target met or not, or the vesting condition? The vesting condition is that if the Kimimla company is going to cut down its scope 1 greenhouse gas emission by an average of 10% per year over the 4 year period, right? So what do you think, if it is the scenario 10, 12, 8 or 11, is the vesting condition met or not? Yes sir, it is met, because on average basis, if I would bring out the average, it is more than 10%. So that means that the condition is met. Okay. As at 31st December 2006, none of the director had left Kimimla company or were expected to leave in the next 12 months. So at the start of the current year, that is the 2007, none of the director left. That means at the end of the year end, the previous year, all 10 directors were the employees of the company, and at the end of this period as well, they are the employee of the company. Kimimla was on track to meet the greenhouse gas target, meaning that the share option were expected to vest. So at the year end of 2006, okay, I'm talking about 2006, no director left them, and also Kimimla company was on track. So if it was on track, the expense would be recorded, all right. But the share-based payment scheme was correctly accounted for in the financial statement for the year ended 31st December 2006, and also they are saying that till 31st December 2006, all the accounting treatment related to this share-based payment scheme is correctly accounted for as per the IFRS 2. Okay. So what is for the current year? At 31st December 2007, due to the unanticipated changes in the production processes, the greenhouse gas target was not met. So this is the scenario. Now let me ask you one thing, that can you guys tell me that is it a market condition or non-market condition? We all know that market condition means the condition which is linked to the market numbers or the market performance. For example, share price, for example, PE ratio. And non-market condition is related to your internal performance like revenue increase, cost reduction, employee satisfaction, employee retention, reduction in the carbon emission, scope 1 emission. So this is the non-market condition, right? And in non-market condition, what do? You at every reporting date, you evaluate or you estimate that whether or not the target would be met or not, right? At the end of the 2000X6, it was on the track. The company was on track to meet the target, and that is why the expense would have been recorded. So let us see how much expense would have been recorded for the 2000X6. So first we will say there are 10 directors. Each director will get 15,000 share options, and each share option is $8 per option, and the vesting condition or the vesting period is 4 years. So this would be in 2000X4, 5 and 6. So this would be 3 upon 4. This much amount of the expense would have been recorded till the end of the 2000X6. Now at the 2000X7, this is the end of the vesting period, and you see that the target is not met. So that means that no further expense would be recorded. And not only this, that no further expense will be recorded, also this would be reversed. And from where it would be reversed? Will it be reversed from profit and loss account, or it would be closed in the equity? I need you to think about it. Yes sir, it will be closed from the P&L and not will be it would be reversed through the P&L and not would be closed through the equity, because it is a non-market based condition share-based payment scheme. And in non-market based share-based payment, you, whenever the target is not met, you will reverse the expense which has been recorded till date through profit and loss account. All right, so this is how the answer is going to be. Now let us go to the sample answer and see what examiner has drafted and how examiner has drafted. Keep the technique into the mind that first you have to mention the requirement of the IFRS, that as per the relevant IFRS, this is the case, this should be the treatment, and as per the scenario you will then give your accounting treatment. Now let's read share-based payment. In accordance with IFRS 2 share-based payment, an expense should be recognized. We all know that the expense is going to be recognized over the period of the vesting period. Okay, in respect to the share-based payment scheme over the 4 year, that is the vesting period, based on the number of options expected to vest. As an equity settled scheme, the expense is measured using the fair value of the option at the grant date, which is $10 per option. You see how all the elements which you are applying in your working, examiner has simply mentioned these elements from the IFRS 2 perspective. That IFRS 2, first IFRS 2 asks you that you have to record the expense. You have to record the expense over the vesting period. All right, and the vesting period is 4 years. And how much expense you are going to record? You are going to record the expense based on two things, that the number of options to be vested, and how much is it? It is 10 directors multiplied by 15,000 share options, and also the fair value of the options. For the equity settled share-based payment, we always take the fair value at the grant date of the shares or the option or the instrument, right? So these are $8. So that is how examiner has just explained beautifully all the requirement of the IFRS, and also told in the answer that what are going to be the elements or the factors to be used in the working. And then greenhouse gas target is a non-market performance condition. We all know this. This is, see, whatever you know you have to mention to explain the examiner that whatever you are doing in your working, why you are doing because it is a non-market condition. Okay, and as at 2006, and it was expected to be met, and since it was expected to be met, the expense would be recorded and equity recognized. That means that the this expense in the profit and loss account, and this is going to be the share-based payment reserve, right? This is going to be debit going to be credit. By this date would have been $900,000 for 10 directors, 15,000 shares, $8 fair value at the grant date, and the 3 years period have been passed. So 3 upon 4. This is till the year end of the 2000X6. Now for the current year. In the year 2000X7, the share option did not vest. Why it did not vest? Because the non-market condition, performance condition was not met. As such, the $900,000 expense and the equity recognized should be reversed. So what you will do, you will credit the profit and loss account and you will debit the share-based payment reserve, and that's it. This is how you're going to explain it. So the simple working which you are going to do in 2 or 3 lines, you have to just explain it in a proper, or I would say reasonably good English, and it would be more than enough. Nothing fancy needs to be done. So this was the solution of the question number 4 part C. I hope that I was able to explain you all the relevant concepts and also the drafting technique. So till then the next lecture, take care of yourself. Allah Hafiz.